Optimizing Tax Strategies for Ontario Entrepreneurs, presented by myself, Adiyan Arafin. Here we have the overview, which overlooks all of the topics that we'll discuss in this slideshow. Kicking off with the introduction, entrepreneurs in Ontario face a complex tax environment, and navigating through this landscape effectively is crucial for minimizing liabilities, but also maximizing business sustainability. The purpose of this is to explore tax optimization strategies tailored towards Ontario business owners, as well as to identify key deductions, credits, and structures that enhance tax efficiency, and to provide practical, research-backed recommendations that align with the CRA regulations. Moving on to choosing the correct business structures, we begin with the most simplest one, the sole proprietorship, which consists of one singular owner, and it is the easiest to set up, income taxed at personal rates, as well as the liability is fully on the owner. Next, we move on to the partnerships, where it is two owners or more who share their ownership and their tax reports. They also require a legal agreement between the two, and it offers flexibility but also shared risks. Finally, we have a corporation, which is a separate legal entity of its own, and it has limited liability protection, more administrative work, however, there are tax advantages. Speaking of tax, we go to the tax deductions and credits. Starting off with the common deductions, we have office rent, utilities, equipment, also vehicle and home/office expenses, as well as employee wages and benefits. Next, we also have the available tax credits, and this consists of small business deductions, SR and ED credit, as well as Ontario Innovation Tax Credits, and also digital media tax credits. Delving into tax even further includes the GST as well as the HST considerations. So the registration and collection, first we're going to talk about how it's required once taxable revenue exceeds $30,000 annually, as well as businesses, they must collect and remit GST/HST on taxable goods/services. Input tax credits, recovering GST/HST paid on eligible business expenses, and it helps reduce net tax payable to the CRA. Now talking about income splitting and compensation strategies. First, we have salary, which is a deductible expense for the corporation, and it also creates room for RRSP. Dividends, however, they're lower tax rate, but they're not deductible, meaning there is no room for RRSP. Family income splitting, however, involves paying salary/dividends to family members, subject to CRA attribution rules, and it can overall lower the household tax when applied correctly. Now, some proposed solutions include the following. So we have structuring strategically, as in incorporating when income levels justify tax advantages. We also have to maximize deductions and credits by tracking as well as consulting with advisors. Furthermore, stay GST/HST compliant. So that means registering once the 30,000 threshold is met. We also have to optimize compensation as well as planning ahead. This brings us to our conclusion. Overall, optimizing taxes is not just about saving money, but it's about building a sustainable, compliant business foundation. With the right structure, smart use of credits and deductions, and proactive planning, Ontario entrepreneurs can significantly reduce tax burdens and overall reinvest in growth. Here are a few of the following that can help businesses grow, such as structuring themselves for success, maximizing financial efficiency, and staying compliant. Overall, I'd like to thank you very much for watching